Barron's, a leading American financial weekly founded in 1921, has published its top 10 undervalued and cheap stocks for 2025, and beyond that, we should be interested in, and we will comment on them today. Their stock picks have not been bad historically. In 2023, their stock picks appreciated by 31%, while the S&P 500 index appreciated by only about 24.5%, and even in 2022, they beat the index by 10 percentage points. So it seems that they are not amateurs, and we could at least be inspired by their selection of cheap stocks. I guess none of us likes to overpay for things, and that goes for stocks too. I've added some of these stocks to my watch list on Money. After we go through these 10 cheap stocks according to Barron's, I'll rank them from the one I like the least to the one I find the most interesting in terms of return on investment. Hi, welcome to another investment video. As an investor who doesn't like to rely solely on passive investing in ETFs and likes to spice up my portfolio with some interesting stocks and companies, I constantly monitor the market and look for new opportunities, whether for myself or for people in the community and our investors at Barron's. When I look at my portfolio in Money today, it is up 20.5% since the beginning of the year, mainly due to good stock picks for the portfolio. If I had to name just a few, it would be AMD, ASML, WBD, SOFI, MICROSOFT, and of course Google, which is now my largest position here in the public portfolio. Looking back, one of the Barron's tips from last year, specifically November 2024, was Google. They said Alphabet shares could grow by 50%. I went through their thesis and mostly agreed with it. They said it was a great opportunity compared to the rest of the S&P 500 index, especially the largest companies. Alphabet had a forward P/E multiple of 19 at the time, and I started buying slowly this year. As you can see from my last purchase this year when I bought 100 shares at around $150 per share, I am up over 60%. So this idea worked out well for Barron's. Let's take a look at their ideas for this year, and I must admit that I was unaware of most of them until now. The first company that Barron's views as deeply undervalued is Option Care Health, ticker OPCH. You may not be familiar with it because it operates in a rather specific business. It is the largest provider of infusion therapy in the U.S. In other words, it delivers complex medications directly to patients' homes or to its more than 170 clinics across America. How are they doing? Since the beginning of the year, the stock is up approximately 23%. Why does Barron's believe in OPCH? Home healthcare is a trend. An aging population, more chronic diseases. People want comfort instead of hospitals. They are like Uber Eats for medications. Instead of pizza, they bring you an infusion to your home. This market is estimated to grow by almost 9% annually until 2030. The valuation is low, PE around 16 and free cash flow yield over 5%. For those who don't know, the P/E ratio is nothing complicated. It's basically how many years you'll wait for the company to earn back what you put into it. With a PE of 20, you might wait 5 years. Risks, they have a lot of debt, and healthcare in general tends to be volatile. Personally, I don't really go into healthcare, but Barron's is clear here. Undervalued stock, large growing market, and stable story. Another company that Barron's ranks among undervalued stocks is Twilio, ticker TWLO. You may already be familiar with this company, as it is a software company that provides communication between companies and their customers, SMS, notifications, calls. How are they doing this year? Since the beginning of the year, the stock is down about 3 to 4% because it fell sharply after the results. And that is precisely the moment that Barron's sees as an interesting entry point. Why does Barron's believe in TWLO? The company has not fallen short of revenue estimates for 20 consecutive quarters. On the contrary, it has exceeded them every time. The model is pay as you go. Customers pay a few cents for each message or interaction, so as their usage grows, so does Twilio. The entire communications market is estimated to be worth more than $100 billion, and Twilio is taking an increasing share of it. The valuation is low today, PE around 21, free cash flow yield around 4.5%. But beware, large customers, once they grow enough, can build the technology themselves. This is what happened to Uber, for example. It used to use Twilio, but now it has its own solution. Conclusion? Barron's says cheap valuation, stable results, and still a huge market ahead of them. Personally, I would be more cautious. I prefer Google with a PE of 25 to Twilio with a PE of 21. But if you're looking for a growth stock at a discount, here you go. U-Haul, ticker UHAL. The third company from Barron's selection is U-Haul, ticker UHAL. It's something of an American symbol of moving. If you've ever seen white vans with an orange logo, that's it. What does Barron's say? U-Haul has over a 50% share of the moving market in the U.S. Its fleet includes nearly 200,000 trucks and 137,000 trailers, plus over 23,000 rental locations, meaning that 90% of Americans have a U-Haul within 5 miles of their home. That's a huge network. Profits should grow because the company is currently going through a period of writing off older vehicles purchased years ago. In America, U-Haul is like if PPL opened a van rental company on steroids. When you move, the chances of seeing a white truck with an orange logo are almost 100%. My note, it's an interesting business, and there are network effects, but for me personally, it's more of a pass. Barron's has a point, a large network and new sources of profit, but these aren't the most interesting stocks I'd want to hold long-term. ELF Beauty, ticker ELF. The fourth company on Barron's list is ELF Beauty, ticker ELF. How have they been doing since the beginning of the year? YTD performance is around plus 10% for this year. Sales in fiscal year 2025 grew by 28% year on year. What does Barron's say? ELF stands out. Instead of traditional advertising, it uses TikTok, social media, and partnerships with Dollar General. Cosmetics for the TikTok generation. It offers almost the same as Dior or Estee Lauder, but for the price of 2 coffees from Starbucks. Thanks to its smaller size, it has even greater potential to grow faster than the big players. Marketing, in the second quarter alone, they spent over $78 million plus 5% year over year. History, they often give conservative estimates and then exceed them. Risk, cosmetics are very volatile. Estee Lauder rose, then fell. ELF may experience the same. My view, Barron's has a point. Strong brand, great marketing, growth. But the year-to-date decline shows that even top brands can falter on the stock market. Honestly, indices will no longer grow as they used to. In recent years, we have lived in an era of cheap money and low interest rates. Central banks pumped in trillions, globalization reduced costs, and tech giants drove the entire market upward. This will not be the case in the next decade. It is no longer likely that ETFs will average 10% per year. That is why it is increasingly important to learn how to select individual stocks. I myself have been doing this more than ever before. In our community, I analyze companies in detail and share specific purchases. And the results? In the last 19 months alone, the average stock I bought in the community is up plus 44%. You can compare that to anything your bank or financial advisor gives you. We have over a 90% success rate among our students. That means that 9 out of 10 people have built a profitable portfolio after graduating from the community. 90% are more financially literate. My community costs 1,200 Czech korunas per month, but the know-how and experience you gain there will stay with you forever. The decision is yours. You can find the link in the video description below. The fifth company Barron's picked is pretty exotic. Inodata, ticker INOD. You may never have heard of it, but it's been on a roll in recent months. Since the beginning of the year, the stock is up more than 80%. Why? Inodata does what is absolutely crucial for artificial intelligence today. It cleans and validates data. It has its own technology and an army of over 6,000 consultants who help large AI models become smarter, less biased, and more accurate. Behind-the-scenes info, Inodata's services are already used by 5 of the Magnificent 7. That's quite an impressive track record. Revenue from its largest clients has grown from $8 million in 2023 to $135 million per year, showing that demand is skyrocketing. Caution: the stock nearly doubled in value within a few weeks after the Barron's article, so it's definitely not cheap today. But the story, AI, data validation, big tech clients, is a theme that could continue. My view, an interesting play on AI. However, after such growth, I wouldn't buy the stock today. In any case, Barron's sees it differently. The sixth stock is Vertiv, ticker VRT. It's a lesser-known company, but it plays an important role. It supplies cooling and power to data centers. And who is building the most data centers today? Of course, big tech. Performance? The stock has grown by about 20% since the beginning of the year. Why does Barron's continue to believe? Vertiv is linked to the expansion of AI in the cloud. Every new data center needs their technology. The company has had 10 consecutive quarters of better-than-expected earnings per share. Management has improved its margin outlook. They want to jump from 18.5% to 20%. The point? Vertiv is like a pickaxe supplier for the digital gold rush. It may not be the most visible, but it profits every time the big players expand their capacity. And that's a story investors love. Personally, if I were to buy a company that serves big tech companies, I would just buy big tech companies like ASML, Google, Microsoft, etc. Of course, you may see it differently. Selecting individual stocks for me, if you devote time to it, can earn you much more money. However, for many busy people, an ETF portfolio that delivers market averages may be a good choice. Analysts from the XTB investment app, with which I have been working for a long time, have created a comprehensive ebook for you on several ETF investment strategies and portfolios. If you are interested in how to build an ETF portfolio in different ways, check out the ebook, which is free to download from the page below the video. And let's go to the seventh company on Barron's list is Aptiv, ticker APTV. At first glance, it looks like just another ordinary car manufacturer, but that's a mistake. Imagine a car as the human body. Aptiv is the nervous system. Cables, sensors, and a brain that monitors safety. The point is this. Aptiv has two parts. One is the classic auto business, cables, components. But the other is a completely different story, software and safety technology for cars. And this part has double the margins and huge growth potential. How are they doing? Since the beginning of the year, the stock has gained about 40%. Barron's expects it to reach $100. That's still about 20% higher risk. If investors continue to perceive Aptiv as just another car company, the price could easily fall back to $70. But if the market values the software parts separately, it could be an interesting story. My opinion, Aptiv is not as sexy as Tesla, but it could become a key supplier of brains and safety systems for the cars of the future. However, I don't like the automotive part, only the software part, so for me it's not as attractive as it is for Barron's. The eighth company is First Cash, ticker FCFS. You may not know it, but it is the largest pawnshop network in the US and Mexico, with over 3,300 branches. How does the business work? The customer brings in an item, such as a watch, laptop, bicycle, or jewelry. First Cash appraises it and immediately gives the customer cash. If the customer later redeems the item, they return the money with interest. The interest can be really high, as much as 200% per year, but because the amounts are small, $50 or $100, people accept it. If the customer does not redeem the item, the company simply sells it on. This is important. First Cash is not just a pawn shop, it is essentially a mini bank for people who cannot get a loan from a bank. No paperwork, no income verification, just bring in your item and get cash. Why is this interesting right now? They make a lot of money on jewelry. When gold and silver prices are high, customers can borrow more, and at the same time, the company has more valuable inventory to sell. The model is two-pronged, either interest income or sales of items. In both cases, First Cash wins. Barron's says the stock is now trading at a forward PE of around 17, while the long-term average is 23. This means that the company is relatively cheap. YTD, the stock has added around plus 40%, so it is already showing that investors are interested in it. A mini bank for ordinary people. Bring in your watch, get cash, faster than anything Česká spořitelna could manage. My view, First Cash is not a sexy AI company, but it shows the power of a simple business model. It has scale, stable demand, and the ability to generate money even in times when people need cash fast. It's exactly the type of company that can surprise you in the long run with how consistently it makes money. I really like this business. The ninth company on the list is QXO, ticker QXO, and this story is mainly about one person, Brad Jacobs. Who is he? Jacobs has a net worth of nearly $17 billion. He has previously built giants, United Rentals and XPO Logistics. United Rentals, plus 400% in the last 5 years, 4 times what the S&P 500 has done. XPO, plus 340% in 5 years. What does QXO do? QXO focuses on digitizing building materials and material distribution. It targets a huge market. In the U.S. alone, building materials are sold for hundreds of billions of dollars a year. QXO wants to combine logistics, software, and acquisitions of smaller players to create a modern distributor of building materials. Stock performance, up more than 25% since the beginning of the year. Risk, the whole story rests on virtually one person, key man risk. If Jacobs fails to deliver or leaves, confidence could quickly evaporate. My opinion, this is not a classic investment in the industry, but rather a bet on a visionary manager. If Jacobs repeats his hat trick, QXO could be a big story, but it's more of a minor position in the portfolio than a cornerstone. The 10th and final company is a completely different story, JBS, ticker JBSAY. It is the world's largest producer of beef and poultry and the second largest producer of pork. The Google of meat, they are so big that even if they shut down half of their lines, they would still feed half the world. What makes it interesting? Its enormous size and dominant market position. At the same time, the stock trades at a forward PE of around 7, which is significantly cheaper than its competitors such as Tyson Foods. The company has a 5-year plan to invest $1 billion a year in expansion, from new sausage plants in the U.S. to expanding pork capacity. Stock performance, JBS is up about plus 12% since the beginning of the year. My view, JBS is a classic deep value story, the largest player in the industry, selling cheaper than its competitors. It's not a sector for everyone, but for those looking for a stable food business at a discount, this giant deserves attention. So, if I rank them from the ones that interest me the least to the one that makes the most sense to me, at the bottom of the list is JBS, JBSAY, a giant meat processing company, cheap, but the sector doesn't really appeal to me. Then U-Haul, UHAL, a large network of movers, but a rather boring story for me. Similarly, Option Care Health, OPCH, healthcare and home infusions, interesting but not my style. In the middle, I would put Twilio, TWLO, software, good track record, but the business model has weaknesses, and also Aptiv, APTV, interesting software part, but still too reminiscent of classic automotive. Then it starts to get more interesting, ELF Beauty, ELF. Inexpensive cosmetics, marketing on TikTok, nice growth story. InnoData, INOD, pure AI play, data validation, huge demand. Vertiv, VRT, supplies cooling and power to data centers, profits every time big tech expands its capacity. In second place is QXO, a pure bet on Brad Jacobs, who has already proven himself capable of building giant businesses. And number 1, First Cash, FCFS, pawn shops and microloans. A simple model, huge network, and cheap valuation. For me, the biggest surprise on the whole list was these 10 cheap stocks according to Barron's. I myself believe today that ETFs alone will not be enough for the next decade. That's why I'm focusing more than ever on selecting specific companies. I share my analyses, portfolio, and specific purchases with our community, and in the last 19 months alone, the average stock I bought there has grown by 44%. If you want to see my other purchases and join thousands of investors, you can find the link to Patreon in the description below. Oh, and if you want more information, here it is. Take care.